Welcome to today's RightTraining webinar on modeling the most common retirement what-if scenarios. My name is Jilliana, and I'm the Customer Relationship Lead here at RightCapital. I'm really glad you could join me today as we dig into some of the most frequently asked what-if questions that come up in client conversations and how you can confidently model them in the platform. Whether it's early retirement, a major market downturn, or exploring Roth conversion strategies, clients often want to know what happens if. And this webinar is all about showing you how to use RightCapital's tools to answer those questions clearly and effectively. Today, we'll walk through a quick overview of our case study clients, Patrick and Brittany, how to model 5 or so of the most common what if scenarios, and we'll also explore where tools like Social Security, tax strategies, and stress testing modules fit into the process. We've got a lot to cover today. I've got about 40 to 45 minutes of content lined up, and I'll stick around for a live Q&A at the end. So as we go along, feel free to pop your questions into the Q&A box below, and I'll answer as many as I can before the hour is up. But with that, let's jump right into it. I'm going to start with the blueprint today. And the blueprint tab is found under the profile and then blueprint tab of our plan. And the reason I'm starting here is just to give you an idea of who we're working with and to get you a little familiar of the clients that we'll be modeling for today. I always like to point out that the blueprint is a great place to start as well if you're doing live client presentations with the clients, because we all know that time is super valuable and you don't want to spend the bulk of the presentation reviewing each and every data entry point. So again, a lot of advisors will start off on the blueprint tab because it's a easy to read interactive visual of the client's financial life. So today we're going to be looking at Patrick and Brittany Mahomes. We have their total net worth lined up here. And then we also have their assets and liabilities broken out by owner. So we can see the assets in the bank accounts, investment accounts. We can also see any liabilities in the plan. This plan does have a primary home as well as a Florida condo, which is currently an investment property. And then we also have Brittany's assets here. And there is one child in the plan who we are planning for college for. We can take a look at the goals timeline as well. And if I scroll down here, we can see we are planning for Tina's college. We also have Patrick and Brittany's retirement when they hit their respective ages of 64, long-term care, and we have some vacation goals in the plan as well. Alrighty, and then lastly, we just have some income, saving, and expenses just to show us what we're bringing into the plan. Both of these clients do have a salary. They are estimating their Social Security benefit, and we have some 401k savings as well as those living expenses for the clients. But all right, now that we've covered Patrick and Brittany's financial future in the Blueprint tab, let's dive right into modeling some of those what-if scenarios in our Retirement Analysis tab. So I'm going to scroll up to the top here and spend some time up in Retirement, and then we'll land on Analysis. This is where advisors will spend most of their time modeling out our what-if scenarios. We can see our current plan displayed on the right-hand side here, and this is based off of all of the inputs in the Profile tab. And then by default, the proposed plan looks identical to the current plan, but we can utilize the action items down below to make changes. A very common question we hear is, what if I want to retire early? Can I still hit my goals, right? We hear clients say this a lot. If they can still hit their goals could mean maintaining a certain probability of success, preserving ending assets, or just feeling confident that retirement won't be derailed by making the jump a few years sooner. Since we have all those key inputs in the plan that we saw on the blueprint, we're in a great position to model that question. We'll start simple and use the action items down below, and we can see in the action items that we can adjust Patrick and Brittany's retirement ages. So we can adjust the slider here. We can either use the slider and drop this down, or we can click in the text box and type in the age that we want to model their retirement. So let's say we want to play around with them retiring at age 60s respectively. I'm going to make those adjustments and then I'll scroll down and hit refresh on my screen here, and we could see the plan run through and make this adjustment. This gives us a fast and easy way to evaluate whether earlier retirement is feasible based on their current plan, right? But let's take it a step further. In most cases, early retirement doesn't work by itself. We might need to make a few adjustments to maintain that plan's strength. Let's say we're aiming for an 80% probability of success or above, which is a common industry benchmark. If the updated retirement age causes the plan to dip below 80%, like we can see here, we can explore a few different options to bring that back up. For example, if I scroll back down to the action items here, we can make some adjustments like increasing their savings. So we can maybe look at just maxing out their 401k contributions to really maximize the last couple of years of work that they both have before we get to retirement. And then we can even put a little less stress on the plan by reducing those pre-retirement expenses. And we could do something really manageable and maybe just decreasing them by about $200 a month. We can also utilize a retirement spending strategy. This can uh, look like retirement spending smile, which is one of the default strategies entered within RightCapital when you create a plan. We can utilize this one, and essentially what it does is it allows us to use our pre-retirement living expenses, and then when the clients hit retirement, we decrease that spending a little bit, and then we allow for an increase very later on in the plan to help us cover retirement health costs. So it looks, when you're looking at a graph, it looks like a smile, which is why we often refer to it as our retirement spending smile strategy. But now that I've made all of these changes here, I'm going to go ahead and hit refresh on my screen again. You can also hit enter on your keyboard, just a quick tip. And if we scroll back up to the top, we can actually see that we were at a 78% probability of success with just the retirement ages. But now that we've made some of these changes, we've been able to bring the plan back up. This shows us the combined effect of these changes. And from here, we can walk the clients through, hey, if we retire at age 60, these are the items we would need to tweak, that's spendings, savings, and retirement cash flows to make this a realistic and sustainable plan for your goals. I know this may seem like a simple scenario for some of you who are RightCapital pros, but it is a foundational one, and it comes up frequently with clients who are exploring what's possible in their retirement timeline. Another really common scenario is something like downsizing or moving from a larger home to a smaller home in retirement. I'm going to show you guys how to model that one as well. It's a very common scenario we see with a lot of advisors modeling things for their clients. But I want to do one more thing before we go in and model that scenario, and that's going to be creating an additional plan to isolate that variable from the changes. So what we can do here is hover our cursor where it says current plan. We have this little pencil icon. If you click on that, it'll open up another window for us. We have the ability to add or remove additional proposed plans here. If we click add a new plan in the bottom corner, it's going to give us a copy of the current plan. We can also create a copy of the proposed plan. So say we wanted to build off of the changes that we just created, and then we also wanted to show what happens if we move on top of this. I'm going to click copy of our current plan. And in this case, we're going to model those clients moving into their Florida condo, right? Remember we saw that Florida condo in the blueprint tab. So I'm going to title this Move to Florida Condo so we can keep track of that change. I'll click the check mark and I'll hit OK to save it. Now I'm going to go ahead and select our Florida condo plan on the left-hand side here. This is the plan we're going to make changes to. We can see we clicked copy of the proposed plan, so all of our changes have been saved. And then to build on top of this, we're going to model moving into that Florida condo. Since it's an existing home, all we have to do here is we're going to click edit at the very bottom, which is going to open another window for us to add or remove action items. And since we're proposing a new move, we're going to click on add new items in the bottom corner here. We're going to hover over goals to find that property goal, hover over property, and then select primary home relocation. Now, the primary home relocation card encompasses a lot of different options. Not only can we model buying a brand new home with it, we can also model inheriting a home, renting, or moving into an existing home. That's what we're going to utilize right now since we're moving into that Florida condo. I'm going to title this Move to Florida Condo so we can keep track of it. right? I always recommend titling your cards as easily as you would like to keep track of all the different changes. So it's easy to remember what we've done. And then let's say we're going to do this in retirement. So I'm going to adjust this to occur for Brittany's retirement since she's the second retirement occurring in the plan. And then we're going to select move into, and we're going to pick our Florida condo. The very bottom field here allows us to decide what we want to do with the current home. In this case, we'll just sell it. However, we do have the option to convert it to a vacation or a rental home if that's something you're exploring with your clients as well. I'm going to go ahead and hit save here. And once this refreshes, it'll rerun the Monte Carlo and we can see what this does for our probability of success. So we do see quite a bump in our probability of success here. And then I also just want to show you in our cash flows tab where we can see the primary home relocation occurring. I'm going to set this to baseline, and then we want to make sure we have our proper plan selected in the cash flows here. So I'm going to select move to Florida condo. And then once that loads, I'm going to click on the summary. We'll then be able to see during Brittany's retirement, if we look at our other inflows column, we see the sale of the primary home. So this is the proceeds from the sale of our primary home. And then we will also, if we were purchasing a new home, we would see the purchase price develop in the goals tab. But since we moved into an existing home, we're not going to see this here since we already have the home in our ownership. So we're not going to see a goal populate here for a purchase price. However, if we did purchase a new home, we would see the goal populate in there for a home purchase. Perfect. Popping back into retirement analysis here. All right. The other great use case for creating additional proposed plans in the system is scenario comparisons. So something like comparing scenario A to scenario B. One of the most common options is looking at down payment options when purchasing a brand new home. What we'll do here is create two additional proposed plans, and we'll model purchasing a brand new home for these clients in retirement at a 20% down payment and then a 50% down payment. So I'm going to go ahead and add or remove plans next to the current plan, right? Click on that pencil icon. And then in this case, I'm going to add a brand new plan and copy the current plan. And we're not going to use any of the adjustments we made in the original proposed plan and the move to Florida condo. I'm going to title one of these move to Florida at 50%. And that'll be a 50% down payment. And then we'll add a second one here, and it's going to be moved to Florida at 20%. And this will be a 20% down payment. I'll go ahead and hit OK. And then we're going to do something very similar here where we're going to select the plan we want to edit on the left-hand side. We'll scroll down to the action items here, and we're proposing a brand new home purchase. So edit, add new items, goals, property, primary home relocation. And we're going to title this 50% down payment so we can keep track of it. Our purchase price is going to be $500,000, and we're going to move to Florida. And this is again occurring at Brittany's retirement. I'm going to leave some of these fields blank, but of course, as you're doing this modeling, be sure to enter the relevant information that you have. We're going to model that 50% down payment with a 30-year mortgage and an 8% interest rate. I'll go ahead and click Save. Perfect. And then one more, we are going to look at our move to Florida at 20%. I'm going to scroll down again, same process, edit, add new items, goals, property, primary home relocation. And I'm going to quickly plug in our values here for our 500,000 purchase price, moving to Florida. What is this? 20% down payment at Brittany's retirement. And this is our 20%, 30-year mortgage at an 8%. We're going to keep the other variables the same to just isolate that down payment difference. Now, once we have both of these occurring in the system, what we can do is a nice side by side. So we have the 20% on this side. I can put the 50% on this side, and we can actually see a side by side comparison of the differences between the two plans. In this case, the probability of successes are pretty similar. We do have a slightly higher median ending portfolio value with the moving at 20%. So just a great spot to narrow down the options with the client and have a conversation with them about what exactly they are looking for and what would make sense for their goals, while also utilizing the features and results that we get from our Monte Carlo to give us an idea of what the expectation of the output would be if we were to choose one option or the other. So this can be a really helpful strategy, not only for relocation scenarios, but also for other kinds of comparisons like different retirement ages, different Social Security options, different pension options, and so on. So certainly a helpful bit of knowledge to have when creating additional plans like this. Perfect. All right. And the next thing I want to talk about today is debt management. Our debt module is a great way to show the client the value of eliminating debt and using specific debt reduction strategies. Let's move over to our debt module here so I can give you a visual of what's going on. So we find our debt module within our three dots along the top. It's our More menu. And then debt is the very first tab we fall on when we click on that. Let's start with a quick walkthrough for those of you who might not have used the debt management tab before. Sometimes it can fall under the radar just because it's hidden a little bit under this More menu. So I just want to start with the payment tab. This is usually the best place to start as it pulls in all existing loans in the client plan and it displays key details like the current balance, our interest rate, minimum and current payments, and then when we run a strategy, it'll also show the proposed payments as well. But I always like to start here so we can get a clear snapshot and really help us get an idea of prioritizing which debts to target first, whether we want to utilize maybe a highest to lowest interest rate or a lowest to highest balance strategy. Now, the strategies tab is where the real planning happens. So we can utilize the action items below to really give us an idea of changing and proposing specific debt strategies. If I scroll down a little bit just to give you a full picture of the action items, we can see we have our proposed payment strategies, and this allows us to select a payment priority. The options here are highest to lowest interest rate and lowest to highest balance. So for example, we could model proposing paying off debt at the highest to lowest interest rate, and then we can also propose additional monthly payments. So we can take a look at maybe proposing an additional $500 to our debts every month. And then at the bottom here, we have our loans built out, the ones that we've entered over in the profile tab in the net worth. Utilizing this drop down here, we can also propose refinances. So if we really want to get into the weeds and look at refinancing some of these loans, this is also an option to be done within the debt tab as well. In this case, I'm just going to leave it on the proposed payment strategy, but let's hit refresh on our keyboard and see our screen and see what the changes are. So we can see here we have our selected debt. The savings is quite significant, and we can see how much sooner we become debt-free by utilizing this payment strategy here. Now, if we want some additional information as well, the details tab along the top breaks down our annual and monthly payment strategies or payment schedules for each loan, which can be really helpful for that really granular cash flow planning. We can see here, we can pick the specific loan. We can see the payments on an annual basis or a monthly basis, and it shows us the balance, tracking the interest on that, the payments, and then the ending balance at the end of the year. We can also see this on a monthly basis as well of what that looks like. This little icon here is to download anything into a CSV file. You will see this floating around the software, so if you're ever curious on what this button does, if you want to get any of this data into an Excel sheet, that's going to be the spot to do it. Perfect. So now we've done a nice strategy here and we've gotten a good result. So all we have to do now is bring this back into the retirement analysis tab, right? Because our debt management module is isolated. So it's not going to have an impact on the plan until we bring it into the proposed plan. And to do that, we're going to click on retirement along the top. And then we're going to scroll down and let me get a plan here just so we can plug this in. Go and use our original proposed plan, and then we can click our debt strategy in the action items here. We'll select debt proposal and we'll hit refresh on our keyboard. I keep saying keyboard. It is our screen today. Alrighty. Now we can take a look and compare with our debt proposal. We can even isolate this so we can reset all of the action items and then we can just isolate our debt proposal. But using this drop down here is going to be the way to bring the debt proposal that we built out in that debt tab into the proposed plan so it affects the overall proposed plan and we can see how that impacts everything. We can even compare that back to the current plan if we wanted to. Now, this does include the other changes that we had, so there are different variables included here, but if we wanted to isolate it, we could create a separate proposed plan just for maybe debt management, and then we can plug in the debt strategy within that plan so it's fully isolated. So a couple different options on how we want to model those debt payment strategies for the clients. Perfect. Alrighty, so the next common strategy used is our Social Security module. Our Social Security module is found in the Retirement tab still, next to Stress Test here. This module is going to help us compare different Social Security filing strategies, and it'll even calculate the optimal filing strategy to maximize the dollar amount that clients can receive from Social Security over the life of the plan. We can see here we have our annual cash flow comparison, and by default, it's going to compare our optimal strategy to our current strategy. In the action items below, we see the optimal strategy displaying for both Patrick and Brittany. We can see in this case, they are recommending to file at age 70, ideally to maximize those delay credits. But of course, we can use the drop downs to compare and contrast different strategies with each other. So we can compare the optimal strategy to maybe filing as early as possible, and we can see how much more we can benefit from the Social Security strategy to filing and as early as possible. We also have another visual here is our cumulative cash flow comparison, and this gives us our break-even point between the optimal and the current strategy, or whichever comparison you have selected. I find that when having these kinds of conversations with clients, the visuals here in particular can be a really helpful backdrop for demonstrating some of these concepts to clients when it comes to those timing trade-offs. And you can even show them, this is how long you'd have to wait to potentially benefit from delaying. So really powerful visuals here to just highlight and have that client conversation of, that timing conversation for Social Security filing. Now, one thing to note here is the Social Security tab looks at the benefit from Social Security in a vacuum. So it's looking to fully maximize the amount the clients can get from Social Security without considering the other options in the plan. So while we can certainly look at the optimal strategy here in the Social Security tab and compare that to any of our other strategies, we also have the ability to quickly and easily implement the optimal strategy within the bigger picture in the retirement analysis. So if I go back up to retirement and then analysis here, we can utilize a very similar strategy to what we did to our debt proposal, and we can plug in the optimal Social Security strategy. Now we have a lot of items going on in the action items here, so let me just reset our action items. I'll click reset, and that's just going to bring everything back to what the current plan is set to. So there's going to be no differentiation between our proposed plan and our current plan at this point. I'll go ahead and hit confirm. And that's going to bring everything back to normal. It's just so we can isolate and show you the impact of utilizing that Social Security strategy, right? So we're going to find strategies on the side here in the action items. We'll click current strategy and we'll set it to optimal. So that's what the optimal strategy was calculated for us over in this Social Security Optimizer module. I'll hit refresh on our screen. And if we scroll back up, we can see exactly what this does for us. So we can see if we do take the optimal strategy route, we do have a bit of a higher probability of success, as well as a small bump in the median ending portfolio value. So this is a great option when navigating that conversation with the clients. Sometimes we can see where the system is recommending them to delay filing until age 70, but then we'll plug it into the proposed plan and it might show a decrease in the probability of success. Oftentimes, that can be if the clients maybe have a gap in their last year of their salary until they file for Social Security. The gap in time where they don't have that income forces them to pull funds from their retirement accounts, which can decrease the probability of success since we're draining the accounts a little bit. So I always like to recommend utilize the Social Security Optimizer, run the comparisons over there, but then definitely bring it back into the proposed plan so we can get a really good idea of exactly how the filing strategies really impact the overall proposed plan as a whole. Awesome. There is one more strategy I want to take a look at today in terms of building out items in different modules, and that's our tax strategies module. So I'm going to pop over to our tax tab along the top here and then tax strategies. The tax strategies module gives us tools to explore planning opportunities like Roth conversions. Roth conversions are one of the most common what if scenarios that advisors are looking to model for their clients. But then we can also model asset location strategies and withdrawal sequence strategies in this tab as well. So just to give you a quick overview of what's capable here, I'm going to set this to our proposed plan. This drop down here allows us to utilize the metrics that we've selected in the proposed plan. So if we wanted to run conversions on top of moving to Florida with the 50% down payment to purchase that new home, we can utilize that as well. So a lot of flexibility on what type of plan we want to utilize and model conversions on top of. The calibration tab is a great visual when running Roth conversions because it gives us the tax brackets that we can maximize when running conversions. Roth conversions within the tax module allow us to target a tax bracket using our fill up the tax bracket slider here. We can indicate which tax bracket we want to fill up to without exceeding it. In the years that we dip below the conversions, if we take a look, sorry, let me scroll back up here. If we take a look at the chart, we can see any year that the client's adjusted taxable income without the conversions dips underneath one of the metrics that we've selected, the system will try and fill up to it without exceeding it to then run those conversions with that tax bracket target. Before we do that really quickly though, let me just touch on the other strategies we have here in case anybody's not familiar with them. The first one is our asset location strategy. This is our equity allocation. And essentially what this does is it allows us to take the equity portion of the client's asset allocation and choose how we want to divvy that up between all of their accounts, depending on how they're treated tax-wise. Usually that looks like front loading either the taxable or tax-free account buckets with equities and then reserving the tax-deferred accounts for fixed income asset classes. If we take a look at the options here, we can see we can front load either the taxable or the tax-free with those equities first, and then the tax-deferred would typically take the fixed income asset classes, excuse me. We also have an info mark here for some additional information, and then I'll also plug the Help Center as well for some additional information on these strategies, so we can get some extra support if we ever run into questions on that. Of course, if you have questions on it as well, drop it into the Q&A box. I do see those questions popping in, which is awesome. We'll cover those at the end. And then next, we also have our withdrawal sequence, which is essentially how can we be the most efficient in terms of our distributions over the course of this plan? It's really the order of operations in terms of what accounts do we want to pull from first, second, and third when the clients have cash flow deficits occurring during their plan projections. Perfect. All right, let's go through and run a quick conversion here just to show you kind of how the module works. So we can see here that the client's plan dips slightly under our 10%, or sorry, our 12% tax bracket in a little bit of time here. So let's model our 12% target as for the conversions. I'll hit refresh to make that change. And then we can see the very little slight green peeking out there is where we're filling up our tax bracket to that 12% to model the conversions. And we can see a slight boost within our proposed strategy here. That does yield about 200,000 more in tax adjusted ending assets by the end of the plan than if we were to do no conversions. I'll scroll back down to the bottom and I'll just bump it up to the 22, the next tax bracket, just to give you a visual of what it would look like to maximize the 22. And we can see this has a great impact on the plan as well, with almost 5 million more tax adjusted ending assets than the reference strategy. And the reference strategy is, again, if we just did no conversions. I always like to point out as well, if you're ever unsure where to start when it comes to modeling conversions, we do have a solver in the strategies tab along the top here. We can click calculate, and what this is going to do is it's going to take the inputs of the plan and calculate the top 5 strategies to maximize the ending portfolio value of the plan. Now, I know maximizing the ending portfolio value isn't always the goal when it comes to Roth conversions. Sometimes it's maximizing the amount we can pass on to heirs, but we can use the strategies tab as a guide to get us started on what metrics we might need to select for our conversions. So essentially what we'll do here is we can see the top 5 strategies selected with our tax adjusted ending assets on the left-hand side here. And then we have the 3 conversion, or excuse me, the 3 action item metrics at the bottom that we can model. So all we would have to do here now is match the options for asset location. So in this case, it's taxable, tax-free, tax-deferred. We would make that change with the action item below to match it. Same thing for the withdrawal sequence, as well as our Roth conversion strategy. We'll want to make sure to target the right income tax bracket. This can just give us a nice guideline on where to start when navigating Roth conversions for this client. And then, of course, we can continue to make additional tweaks as needed. In this case, I'm going to utilize the strategy that we've built out already with that 22% tax bracket. And I'll take us back to the calibration tab just so we can see that bonus one more time of how much we could really maximize here. And then the summary tab is also a nice visual. It just shows us exactly how many more tax adjusted ending assets. It also gives us that tax comparison. So what are we saving in that tax payment over the length of the plan, as well as the lesser withdrawals from the tax deferred accounts from things like RMDs. Perfect. Now again, this is an isolated module. So in order to bring it back into the proposed plan, we are going to pop back over to retirement, analysis, and then what I'll do here in the action items is I'll set our Social Security back to our current strategy so we can isolate our tax strategy. And then we'll find our tax strategy on the side here. We'll switch it from current to proposed strategy and I'll hit refresh. If I scroll back up here, let's take a look at the difference. And then perfect. We can see quite an increase between the current and the proposed plan. Now with running those conversions, our probability of success has increased significantly, as well as our median ending portfolio value. Wonderful, wonderful. Alrighty, so now that we've covered some of the foundational planning modules, I also just want to shift into a few features designed to handle more complex or uncertain situations. And in this case, I want to start with our stress test module. If I scroll up to the top here, stress test is found under retirement, actually right next to analysis. So I'll click on stress test, and this is one of the most effective and quickest ways to model market volatility or economic stress scenarios. There we go. I was waiting for it to load. Like the retirement analysis, our stress test module is based on the Monte Carlo simulation as well. So we're still looking at changes to the client's probability of success as our main output. Each action item down at the bottom here represents a specific financial stressor, like a market drop, reduced asset returns, or increased inflation. You can use the sliders to adjust each variable and see how that particular stressor affects the plan's probability of success. And the bar chart at the top will update in real time to reflect those impacts. There are a lot of levers we could pull down here, but I like to start by narrowing things down just to keep the conversation focused. One easy way to do that is by opening the edit drawer in the bottom corner here, and selecting a few relevant stressors based on your client's concerns. In this case, let's say we want to talk to Patrick and Brittany about an equity market drop immediately. We can also talk to them about a higher tax expense and higher inflation or increased inflation. I'm going to uncheck everything else that's not relevant. And I am going to leave the combined stress test on just to show you what it looks like if all three of these items were to occur at the same time. Once I have everything checked off that I need, I'm going to go ahead and hit save. And this is going to really narrow down the items that we have to manipulate here. Give this a moment to load. Perfect. Now, let's see here. We have some inputs already entered. Let's drop the markets. We can increase, so let's say the tax expenses increased only by 10% and inflation by 1.5. I'm going to go ahead and hit refresh on my computer, and just want to note that this module can take a little longer to load than others, and that's totally normal. It's just because RightCapital is running multiple simulations behind the scenes. So there's a couple Monte Carlos going on. It's a lot of computer and brain power. So give it an extra minute, and once it loads, you will have a powerful visual to work with. We can see here that we have a baseline probability of success, so just the current plan, or in this case, sorry, we're basing it off the proposed plan, but you can base it off of the other plans. So in this case, the base proposed plan is 95.8%. And then if the equity markets drop immediately by 30%, we can see what this drops our probability of success to. We can also see taxes stay relatively high. If we were to increase our tax expense, it drops from 95 to 93. And then if inflation increases by 1.5%, it actually drops us way down to 62% probability of success. And then if all of these items were to happen at once, the plan actually drops down to 40% probability of success. So this is a great way to ease client fears or help us pinpoint any loopholes in the plan that we might need to fill. You can even dial these settings up further if we wanted to really model a worst case scenario. If we wanted to see what it looked like if the equity markets dropped by 60%, we can see how much this really impacts the plan. And again, it does just help us pinpoint weaknesses in the plan and have stronger client conversations to really maximize the plan so it doesn't tank as much during uncontrollable or unforeseeable situations. Or if the plan stays really strong, it can help ease client fears a little bit. Before we move on, though, I also like to always note that the stress test and the retirement analysis modules can work together to give clients a more well-rounded view of their plan's resiliency. Right now, we're looking at the proposed plan and retirement analysis, and of course, you can easily change between the different plans here. One thing I've seen advisors do more and more is reframe how they present the probability of success. For many clients, hearing 64% of probability of success, for example, might feel like, oh no, there's a 36% chance that I'm going to fail. But that's not really the right takeaway. A better way to frame it is the percentage represents the chance that we won't need to make any adjustments over the course of the plan. So in that example, a 64% success rate might just mean that there's a 36% chance you'll need to make a tweak somewhere down the road, not that the whole plan falls apart. And this is where the stress test can be a powerful companion. You can make a simple change in the plan, like altering a goal, selling a property, or reducing spending, and then immediately see how that adjustment affects the outcome, both here in retirement analysis and in the stress test. Let's walk through a quick example. Remember earlier in the plan, Patrick and Brittany were planning to relocate to their Florida condo in retirement, right? Instead, let's say we decide to model what it would look like if they sold that property in 2030. We're going to set our tax strategy back to the current strategy. And then to model the sale of the Florida condo in 2030, we have our existing asset sales here. Right now it's set to sell at the end of the plan, but we're going to adjust this to sell in 2030 using this drop down to select the calendar year and then typing the year of sale here. I'm going to hit refresh. And then once I go ahead and make that change, of course, RightCapital is going to update the analysis and see what this does for us. And then We can also pop back into the stress test to see how that new plan with the condo sale holds up under pressure. If it raises the probability of success across different market drop scenarios, that can give the clients a sense of control and help them see how small adjustments can build a more resilient plan. And then, of course, if the probability of success decreases after that change as well, it's just another conversational point to help us really pinpoint and build that strength in the plan so that way, if something were to happen, we've planned for it and we have a strong baseline to protect ourselves against it. So, again, retirement analysis shows you the overall trajectory, and the stress test helps you layer on real world stressors to see where adjustments might help, maybe without being overly alarming. Perfect. And before we wrap up with the modeling tools, I just want to take a moment to highlight another helpful and often underutilized feature, which is the liquidity analysis. We'll find the liquidity analysis under the dashboard area. So dashboard and then liquidity. For clients who are, let me reset my action items here so we can start from scratch. There we go. Alrighty. So, what was I saying? For clients who are nearly uh, at retirement or already in retirement, many advisors like to make sure that there's a solid cash cushion in place, enough to cover near-term expenses without needing to sell long-term investments during a downturn. The liquidity analysis is a simple and effective tool for guiding those conversations. At the bottom of the screen, you'll see a few action items you can adjust. These allow you to set a liquidity target, which is based on the client's monthly expenses that we entered over in the Profile tab. You can choose how many months worth of expenses you would like to get covered, say 6 months, 12 months, 3 months. And then we can even add an additional expense buffer on top of this, say another $200. Once we dial those in, I'll go ahead and hit refresh on the keyboard, and then RightCapital is going to actually recommend the cash cushion based on the metrics we selected in the action items below. It's also going to highlight the actual liquidity that the clients have in the plan, and it's going to give us a visual of the surplus or the deficit that we might have to figure out within the plan. So this gives us a great visual to show whether the client is positioned well or if there's a liquidity gap. It's a simple way to frame an important question of, do we have enough accessible cash for the short term, especially in volatile markets? You can use this as a backdrop for those conversations, and we've seen that it helps clients feel more prepared and reassured about their near-term financial stability. Alrighty, we've covered quite a bit of content today between liquidity, stress testing, we've covered tax strategies, we've covered debt, we've covered modeling A and B scenarios and Social Security in the plan. So as you can see, there's a lot of modeling we could do in the software, and we've only really touched the iceberg and what's possible in the system. So definitely don't hesitate to get your hands dirty within the software and take your time modeling different scenarios for your clients.